We're officially stepping into what I'd call a mini holiday rally. Markets have been drifting higher, sentiment is improving, and volatility has quietly slipped into a zone that historically signals confidence and sometimes overconfidence. Right now, the VIX is sitting in the mid-14 range, and when volatility compresses like this, it usually tells us one thing. Investors are getting comfortable, maybe a little too comfortable. And that's exactly why, instead of pressing harder on risk, I'm doing the opposite. I'm slowly increasing my cash position. In this video, I want to walk you through the data that supports that decision, including a volatility study from TastyLive, and then break down my top cash-secured put ideas I'm watching right now. As always, this is not financial advice. I'm simply sharing how I personally manage my portfolio for educational purposes only. Outcomes will vary for everyone. Now, from a portfolio perspective, things are going very well. We're currently sitting at fresh all-time highs, new highs across the board. And if you're interested in following my long-term journey toward building an 8-figure portfolio, make sure you're subscribed. If this video brings you any value at all, hitting the like button genuinely helps more than you might think. So thank you in advance. Looking at today specifically, we closed the session with roughly $3,500 in realized gains across accounts. That number will obviously fluctuate day to day, but consistency over time is what matters most. And it's not just me navigating these markets. Inside our private community, we now have hundreds of traders actively sharing ideas, results, and lessons learned. That collaborative environment has been incredibly powerful, and I love seeing people support each other's progress. I also continue to share free ideas across multiple platforms, whether it's social media or my newsletter. So if you want additional perspectives outside of YouTube, those links are always available. Now let's talk about the broader environment. From an economic data standpoint, things are relatively quiet. We do have a delayed GDP report coming up, which can move markets, but historically it's not the biggest catalyst. What I'm watching more closely is upcoming labor data, especially jobless claims. That tends to give us a clearer signal about economic momentum. Interest rates remain the real story. According to the FedWatch tool, markets are currently pricing in a meaningful chance of a rate cut as early as March, with April looking even more likely. Lower rates are supportive for equities, they reduce borrowing costs and improve liquidity. As long as expectations for cuts stay on the table, that remains a tailwind. But here's where things get interesting: volatility. When we zoom out and look at the VIX, we're now firmly in a zone that historically reflects optimism. Anytime volatility drops below the 15 level, it tells us traders are relaxed. And while that feels good in the moment, markets rarely stay calm forever. There's a well-documented relationship between low volatility periods and future volatility spikes. When fear disappears, risk often builds quietly under the surface. This is where the TastyLive research becomes relevant. They categorize volatility into 3 phases: low volatility lull periods, expansion phases where volatility spikes, and contraction phases where it cools off again. Historically, these low volatility environments last around 6 weeks on average before transitioning into an expansion. Right now, we've been sitting in this calm zone for about 4 weeks already. Could it last longer? Absolutely. Markets can drift higher longer than people expect, but statistically, the longer we stay here, the more likely it becomes that volatility eventually wakes up. That doesn't mean a crash is coming. It doesn't mean panic. It simply means the risk-reward balance shifts. And that's why I'm gradually increasing cash. At the moment, I'm holding a little over 23% of the portfolio in cash, up meaningfully from just a couple weeks ago. As positions naturally roll off or get called away, that percentage will increase even further. The goal isn't to time the top. The goal is to stay flexible. Cash gives you options when opportunity shows up. If we get a pullback in early January or even mid-January, I want to be ready, not scrambling. Now let's move into the stocks I'm actively watching for cash-secured put opportunities. The first one is Seagate Technology. STX pulled back sharply recently, dropping several percent in a single session. That move brought it down toward key technical levels we haven't seen in weeks. From a chart perspective, it's approaching a zone where buyers have consistently stepped in before. From a strategy standpoint, this is exactly the type of move I look for when selling puts. You're getting paid while the stock retraces towards support rather than chasing strength. I already have exposure here, and if I were to add again, I'd focus on strikes that sit near long-term moving averages. Levels where assignment wouldn't bother me at all. Fundamentally, Seagate trades at a reasonable valuation for its sector, remains diversified, and continues to benefit from structural demand tied to data growth. This is a name I'm comfortable owning if assigned, which is always the key question when selling puts. The second stock on my radar is Google. This is a position I nearly opened recently, but I'm waiting for capital to free up as another holding rolls off. Once that happens, Google becomes very interesting at current levels. The stock has pulled back from its highs and is now trading at a discount relative to where it's been. Selling puts near major support allows me to either collect premium or acquire shares at a price I'm happy with. What keeps me bullish on Google long term isn't just advertising, although that business alone is incredibly strong. It's the infrastructure side. Their investment in proprietary AI hardware positions them uniquely as demand for compute power continues to explode. When supply is constrained elsewhere, internal solutions become a massive advantage. At the right strike, Google offers a clean, risk-reward setup that aligns perfectly with a cash-secured strategy. The third name is Iron, which has recently shown exactly the type of price behavior I wanted to see. After pulling back, the stock found support, stabilized, and began showing early signs of momentum returning. Technical indicators have started to turn positive, and valuation remains attractive compared to peers. This is a slightly more volatile name, which is why I tend to keep duration shorter and stay flexible. The premiums here are strong, and assignment at lower levels actually improves my long-term cost basis. As long as the stock continues to respect support, I'm comfortable staying active here, whether that's through puts or covered calls. Finally, I want to mention a bonus idea that hasn't been discussed much yet, Credo technology. This one checks several important boxes: strong price structure, solid demand trends, and attractive option premiums. While the valuation is elevated, the technical setup is compelling after the recent pullback. Selling puts below current levels allows for a wide margin of safety, and the probability of assignment remains relatively low. If assigned, you're entering near areas where buyers have consistently shown interest. This is a name I'm considering starting small with, especially if volatility picks up and premiums expand. So to wrap this up, markets are strong, sentiment is optimistic, and volatility is quiet. That's not a reason to panic, but it is a reason to be disciplined. Raising cash when things feel easy is what allows you to stay aggressive when things feel uncomfortable. If you found this breakdown helpful, don't forget to hit the like button, and I'll see you in the next one. Take care.